Now let me show you exactly what China has done. And let me give you specific numbers, specific timelines, and specific implications. Because this isn't speculation. This is documented liquidation. China's US Treasury holdings peaked in November 2013 at $132 trillion. As of late 2024, official holdings stand at approximately $760 billion. That's a reduction of $560 billion in direct holdings over 11 years. But the official number doesn't capture the full exit. Remember what I mentioned earlier about custodial holdings. China routes significant treasury purchases through Belgium, Luxembourg, and other financial centers to obscure their position. When Chinese analysts want to hide activity, it flows through these custody accounts. Between 2013 and 2024, combined Belgium-Luxembourg holdings have fluctuated wildly, often moving inversely to Chinese official holdings. Analysis suggests an additional $150 billion in hidden Chinese exposure that has also been reduced. Total estimated Chinese exit, $688 billion, perhaps more. Now let's calculate the damage. When interest rates rise, existing bond prices fall. This is basic bond math. China was selling throughout the most aggressive rate hiking cycle in 40 years. The 10-year Treasury price fell approximately 18% between January 2022 and October 2023. The 30-year fell even more, roughly 35% from peak to trough. If China held an average duration portfolio and sold throughout this period, their realized losses would be, conservative estimate, $80 billion. Middle estimate, $120 billion. Aggressive estimate, $180 billion. Let me put $120 billion in context. That's larger than the GDP of Morocco, Ecuador, or Slovakia. It's roughly equivalent to China's entire military budget for 1 year. It's more than the total foreign direct investment China receives annually. They burned that value deliberately, intentionally, with full knowledge of what they were doing. This is the question that reveals everything. Financial logic says hold to maturity. If you bought a treasury at face value, it will pay face value at maturity regardless of interim price fluctuations. Selling at a loss crystallizes damage that patience would avoid, unless patience isn't available. Here's the strategic calculation China made. Factor 1. Sanction risk. After the Russian asset freezes in 2022, every Chinese strategist recognized that treasury holdings are not sovereign assets. They're permissions. They exist at American discretion. In a Taiwan scenario, in a major trade war, in any serious confrontation, those treasuries become frozen assets or worse. Taking a 15% loss now is better than a 100% loss later. Factor 2. Dollar trajectory. Chinese analysts are not blind. They see the U.S. fiscal trajectory. $36 trillion in national debt. $2+ trillion annual deficits. Debt service now exceeding defense spending. No political will for fiscal correction. If you believe the dollar will depreciate 20-30% over the next decade, today's 15% loss becomes tomorrow's break-even. You're not losing money. You're front-running the depreciation. Factor 3. Alternative deployment. Every dollar exited from treasuries is redeployed somewhere else. Where has Chinese capital gone? Gold. Massive gold accumulation. The People's Bank of China has added over 300 tons of gold to official reserves since 2022. But official figures dramatically understate the reality. Chinese domestic gold production, the world's largest, increasingly stays within China rather than entering international markets. State-owned enterprises accumulate gold without reporting to the central bank. Estimates suggest actual Chinese gold holdings of 4,000–5,000 tons, potentially approaching U.S. levels. Commodities. Strategic stockpiling. China has accumulated massive reserves of oil, copper, iron ore, grain, and rare earths. These physical commodities can't be sanctioned. They can't be frozen. They exist within Chinese control. The Strategic Petroleum Reserve equivalent in China has grown from 30 days of imports to over 100 days. They're preparing for disruption, belt and road loans, foreign leverage. Rather than holding American IOUs, China has issued its own IOUs to 150 countries. These loans give China claims on foreign resources, infrastructure, and political loyalty. When you owe China money, China has leverage over you. When China holds treasuries, America has leverage over China. The redeployment reverses the leverage equation. Now here's what should concern everyone watching. The selling has accelerated. In 2014-2017, China sold approximately $200 billion. The pace was measured. In 2022-2024, they sold over $250 billion, despite rising yields that would logically encourage holding. Despite losses that would logically encourage patience, the acceleration suggests a timeline. Something is driving faster exit. The critical question is, how close is China to completing Stage 3? At current holdings of $760 billion official plus $150 billion estimated hidden, China's total treasury exposure is roughly $900 billion. If they continue the current selling pace, they reach $500 billion by 2027. That's still significant, but it's manageable to lose in a confrontation. If they accelerate to a Russia pace, they could reach minimal exposure, $200 billion, by late 2026. Here's what the pattern says about Stage 4 timing. In the OPEC case, Stage 4, confrontation, major repositioning, came within 18 months of exit completion. In the Russia case, Stage 4, Ukraine invasion, came within 12 months of reaching minimal treasury exposure. If China completes their exit by 2026 or 2027, the pattern suggests Stage 4 arrives by 2028. What does Stage 4 look like for China? Taiwan is the obvious scenario, but it could be broader. A fundamental break in US-China economic relations, a yuan internationalization push, a BRICS currency launch, or actions we haven't anticipated. What the pattern guarantees is this: they're not exiting for portfolio reasons. They're exiting because something is coming that requires financial independence. Let me show you what China's exit means for the treasury market itself, because the implications extend far beyond US-China relations. The United States needs to sell approximately $2 trillion in new treasuries annually to cover the deficit, plus refinancing of maturing debt, which adds another $10 trillion in annual issuance. Total annual treasury issuance requirement, $12 trillion. Who's buying? Domestic buyers, banks, pension funds, households, approximately $500 billion annually. Federal Reserve, QE, currently negative. They're reducing holdings. Foreign central banks, declining. Net sellers in aggregate. The math doesn't balance. And when the math doesn't balance, prices fall and yields rise until new buyers appear. China alone was purchasing $200 billion annually at their peak accumulation. That buyer is now a seller. The hole in demand is structural. The treasury market is supposed to be the deepest, most liquid market in the world, the bedrock of global finance. It's not anymore. Market depth, the ability to execute large trades without moving prices, has declined by 60% since 2020. Bid-ask spreads have widened. Flash crashes that were once unthinkable now occur regularly. October 2022, Treasury yields spiked 40 basis points in a single week. March 2023, bank failures triggered a 50 basis point swing in days. August 2024, yen carry trade unwind caused 30 basis points of volatility in hours. The market that's supposed to be the safe haven has become volatile. And China's exit is a major contributing factor. When the largest foreign holder becomes a consistent seller, market dynamics change. Dealers carry more inventory. Risk premiums rise. The whole market becomes fragile. Every additional basis point of Treasury yield costs the American government billions in debt service. At current debt levels, $36 trillion, a 100 basis point increase in average borrowing costs adds $360 billion annually to interest expense. China's exit alone probably accounts for 30 to 50 basis points of pressure on yields. That's $100 to $180 billion in additional annual interest expense, directly attributable to one seller. And it compounds. Higher interest rates mean higher deficits. Higher deficits mean more issuance. More issuance without more buyers means even higher rates. The spiral is mathematical. China's exit accelerated it. When China sells treasuries, they receive dollars. Those dollars then get sold for other currencies. Yuan for domestic use, euros for European purchases, gold for reserve holdings. The selling pressure on the dollar is persistent, not dramatic enough to cause a crisis in any single week, but consistent enough to erode over years. The dollar index has been relatively stable because other factors, Fed policy, relative growth, have offset the selling pressure. But what happens when the Fed cuts rates while China continues selling? The flows reinforce instead of offsetting. That's when dollar weakness could accelerate. Finally, there's the question of who follows China. Japan is already reducing exposure. Saudi Arabia has diversification agreements with China. India is building rupee-based trade systems. Brazil, Russia, South Africa, the BRICS core are all reducing dollar dependency. If China's exit provides a template that others follow, the Treasury market faces not one large seller, but a dozen medium sellers. The aggregate effect would be unmanageable without Federal Reserve intervention. And Federal Reserve intervention at that scale is called monetization, printing money to buy government debt. The last country to aggressively monetize debt was, well, there are many examples. None end well. Let me bring this to what it means for you. Because China's exit isn't an abstract geopolitical story. It has direct implications for American wealth. The 60-40 portfolio, 60% stocks, 40% bonds, has been the foundation of retirement planning for decades. The assumption was that bonds provide stability when stocks fall. That assumption is broken. In 2022, bonds fell alongside stocks. The diversification benefit disappeared. If China's exit continues pressuring yields higher, bonds face more losses ahead, not stability. For anyone holding significant bond positions, the question becomes, why hold an asset that the largest foreign owners are actively fleeing? If China's exit is part of a broader de-dollarization trend, the dollar's purchasing power will erode faster than the Fed's 2% target suggests. Not crisis, not collapse, just persistent erosion that compounds over decades. $1 million saved today might have the purchasing power of $650,000 in 2035 under optimistic scenarios. Under pessimistic scenarios, $400,000. The difference depends largely on whether the dollar maintains reserve currency privilege, exactly what China's exit challenges. What China is buying tells you what they think survives. Gold, physical commodities, productive infrastructure, claims on real resources. They're not trading treasuries for other paper. They're trading paper for things. The implication isn't that you should replicate Chinese central bank strategy. You're not a nation state. Your constraints are different. The implication is that the smartest strategic thinkers in Beijing have concluded that American paper is not where you want to be concentrated. That conclusion might be wrong, but it's not uninformed. And it's being acted upon with hundreds of billions of dollars. Let me bring this back to where we started. $688 billion, sold at losses, deliberately, strategically. The largest creditor exit from U.S. debt in history. And it's still accelerating. The pattern has executed before. OPEC exited British gilts in the 1970s. They accepted losses. They repositioned toward dollars. Britain's financial hegemony ended within a decade. Russia exited US Treasuries between 2014 and 2018. They accepted losses. They replaced paper with gold. When the confrontation came in 2022, they had financial freedom of action. Japan has fired warning shots. Even allies are hedging. Even friends are diversifying. China is following the same playbook, same stages, same willingness to accept losses, same redeployment into assets outside American control. Stage 1, accumulation, complete by 2013, $132 trillion peak. Stage 2, strategic awakening, complete by 2018, recognition that treasuries are vulnerabilities, not assets. Stage 3, controlled liquidation, now, $688 billion sold, accelerating. Stage 4. The pattern says Stage 4 comes within 18 to 36 months of exit completion. If China reaches minimal exposure by 2026 or 2027, the pattern suggests something significant happens by 2028. I'm not predicting war. I'm not predicting collapse. I'm recognizing a pattern that has never failed to complete. When your largest creditor sells at massive losses, they're not making a financial mistake. They're telling you something about the future they expect. The British didn't listen when OPEC sold. The Americans didn't listen when Russia sold. The question is whether anyone is listening now. $688 billion in sales, $150 billion in accepted losses, a strategic exit executed over a decade, and an acceleration that suggests the timeline is shortening. The exit tells you the intention. The losses tell you the conviction. The acceleration tells you the urgency. If this video changed how you understand what China is doing, if the pattern is now visible to you, I need you to subscribe. The next video is where I show you exactly what Stage 4 scenarios look like. The Taiwan timeline, the BRICS currency mechanics, the market reactions that would follow each trigger. Because this story is approaching its climax. The exit is 2/3 complete. The window for Stage 4 is opening. And the information you need won't be on the evening news until the Treasury market is already moving. When your largest creditor takes $150 billion in losses to leave, they know something you don't. I'll see you in the next one.